Hello, it's Tuesday, November 20th, 2018. I'm Steve Houston with Compass Communications, and I'm here again with Joe Terril of Terril and Company to talk a little bit about the markets and investing. And Joe, we have Thanksgiving just 2 days away, and while we have a lot to be thankful for, there is a lot of trepidation in the markets these days. And I saw today's Wall Street Journal. Tech stocks drop sharply as rout deepens. That seems to have been the theme for the past 6 weeks. You mentioned about 6 or 7 weeks ago, and I've been talking about it during the summer, about a tech bubble that we need to be concerned about. Is this a reckoning we're seeing?
Yes, that's exactly what it is. The people almost for all of 2018 have bought the FANG stocks, if you will, the Facebook, Apple, Amazon, Facebook, regardless of price, because they were going up. Not that Apple and Amazon are not good companies, but they were worth nowhere near the price people were running the stocks up to. And it doesn't surprise me that now, for whatever reason, people have taken a second look, and when they start going down, you get the reverse. Everybody assumes there's something fundamentally wrong, and they start selling all the stocks, and the more they sell them, the more it goes down. So I appreciate your comment about that, because I very correctly said this isn't going to end well. Now, in disclosure of everything, but I am surprised that good fundamental companies are not holding up in this market better than that. I thought they would get away from these tech stocks and run them down, but things such as the bank stocks and the pharmaceutical stocks and the energy stocks would hang in and do just fine, but they haven't. This is now a liquidity-driven market where it's sell everything to raise money. So they're selling stocks not based on fundamentals, meaning how much does this company earn, what's their cash flow, how fast is it growing, what kind of dividend are they paying. They're selling everything. And that part of it surprises me, or I've been wrong about that.
Well, let's talk a little bit about the trade war. Over the weekend, the Pacific Rim Conference is underway, and more shots across the bow in the trade war. What do you see with that lingering issue?
Well, as we've said recently on these blogs, and I've written about in a few speeches that I gave during the course of the year, the trade war has a real potential to become an issue. And I don't know how to handicap, will China and the United States come to an agreement? But I do feel this way. The world economy is much stronger than the markets are giving credit for, and people's perceptions now are trade war, major economic recession all over the world, banks will end up with bad loans, people aren't going to do business. I mean, they've gone from being very bullish to now overly pessimistic about the world economy. I don't believe the United States and China are going to commit economic suicide with each other over issues that can be solved. I look at what the administration did with Mexico and China, Mexico and Canada, and came to a new agreement, if you will, on NAFTA. At the end of the day, that agreement wasn't too much different than the original NAFTA. But it gave the administration the ability to declare victory, tell everybody how great everything is and was, and boy, we sure straightened out Mexico and Canada. No, at the end of the day, there wasn't much difference there. And I think, I hope I'm not wrong, that they'll end up doing a similar thing with China. They meet at the end of November here in 10 days, 2 weeks. In Argentina, I think they'll say, oh, we've got all kinds of great agreements with China, and somewhere start talking about we're dropping tariffs. And the world economy isn't getting ready to go off a cliff.
Well, with this volatile market that we're still in, are you changing your portfolio in any way?
One of the things that I have done on the fixed income side is, as interest rates have come up, we've kept durations on fixed income very short in anticipation of higher interest rates. Our average duration, I don't think, is much more than 7 months. I have bought some 5-year paper recently to extend that duration out a little bit in the event I'm wrong and we do have a recession. Making better than 4% in a 5-year area and pretty good credit, it's appealing. You have to remember also that every day that goes by, the duration gets shorter. So I have done that. Now, one of the things that I will do, it's difficult, but you've got to swallow hard and take that opportunity. If they keep running the market down, and particularly what I call the good, sound, fundamental companies, I'll step in and do a little buying. They calmed down. They initially took bank stocks down, Citigroup and these companies. And then they've stopped, and actually the financials have held up reasonably well. But the market today, as we said, it's Tuesday the 20th of November, the market pre-opening is down again another 400 points. If they run some of these companies down some more, I'll actually step in and do a little buying. These are, there are plenty of companies out there that are generating tons of cash, buying back a lot of their own stock, raising cash dividends, and I don't think their earnings are going to disappear or calamities right around the corner for them. If they want to run the prices down to where they're at bargains, I'll add to some stock positions.
Okay. Thanks, Joe. That's Joe Terril, founder of Terril & Company, independent wealth management with $730 million in discretionary assets under management. Joe, I want to wish you and your staff a very happy Thanksgiving.
And same to you and your family, Steve, and to all of our clients and associates, very happy Thanksgiving to you and your families.
Enjoy the holidays.